The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So let's move on then to a course overview week 2 then. What we'll be discussing is the forces of supply and demand, sector analysis, capital trade flows, and economic data. So with a little context for both, we know that forces of supply and demand are absolutely crucial to pricing assets, particularly for some assets over others. Potentially, you could argue commodities are totally, I suppose, monitored by their intrinsic or external forces of supply and demand. Sector analysis, so we'll be delving deeper into each economy to actually look to how the sectors affect and operate within local economies. Capital and trade flow, so how important the movement of cash or money around the global economy and how that affects trade. And then economic data as well. So not only for the obvious in terms of how it can affect the markets over the long term, but to actually look to approach the markets on any particular day, all traders take into context what an economic data is going to be released to the market. If we want to trade 4 or 5 economic figures, then we certainly can, and that can be your 5 trades of the day. So it's all relative to the type of trading you want to, I suppose, to implement, but also how the overall picture is reinforced by the economic data that we see released to the markets each and every day. So again, the forces of supply and demand. A good trader is one that will have a strong fundamental understanding of the supply and demand forces of the underlying asset he or she is considering trading. Some financial securities have an infinite amount of variables that dictate price, while others trade very closely to their economic functions of supply and demand. Okay, so this is something simple here, and obviously we will break this into a lot of detail when we go through this particular webinar. Here we have the WTI crude oil price, and we see a quantity shift. So there's perhaps potential a demand or an increase in quantity, and that actually causes a demand shift from D to D1. Then you can see there's also a relative qualitative change in the amount of quantity that I am demanding. That price will obviously change as a result. So forces of supply and demand certainly dominate a lot of these markets, and we'll understand then with more context how something like a supply shortage or a real decrease of demand may affect the price of the asset that we may trade. Then we'll be discussing sector analysis, so something really enjoyable in terms of, I suppose, establishing your own concern for equity markets. It really will build upon your knowledge of how these equity markets trade. So here we have, of course, a nominal economy here with GDP there, Q1. So we have around the wheel 100% of GDP there for 2018. We can see it well divided up. So heavily, I suppose, heavily exposed to finance here, the financial services sector. We have 20% of overall GDP there related to financial services. So this may be an economy or a local economy like the UK FTSE, perhaps, because obviously the City of London is heavily invested in financial services. We have government outweighing at 18%, manufacturing and trade is very important, and then smaller services like mining, personal services, the whole way down to construction, electricity, and agriculture. So in understanding these sectors, it will indicate to us a level of industry strength or weakness, of course, in a domestic economy. Conducting a very detailed and intense industry analysis can provide business owners with specific knowledge regarding to economic marketplace. Business owners may discover a market niche not currently being met by other companies, and investors can then speculate on stock prices as a result of such opportunities. Okay, so very important in deriving your own analysis from how these sectors are actually operating and contributing to GDP in an economy. So here we have evidently our FTSE 100 sector weightings here, with oil and gas being quite high up there. Of course, we know that Shell, BP, quite large companies within the FTSE 100 in terms of their weighting. Basic materials are very important again, 21% there. We have an outweighing factor there, um, which is going to weigh down on the price of the FTSE, of course. So as traders, we'll want to acknowledge when certain sectors are either strong or weak within an economy or region, and learn to exploit these conditions in the financial markets. That is very true. That is simply what we're trying to do. The more context or the more understanding we can get about sectors within an economy, that we know that there will be shifts according to some news flow that will be released, and our job as financial traders is to profit. So we're looking to exploit these conditions within the markets. Fundamental analysts select securities on the basis they will outperform against other competitors in the same market or industry. So again, there's so many different ways you can trade with your knowledge of sector, I suppose analyzing different sectors. Perhaps one company is slightly undervalued, even though it's performing just as well as another in a certain sector. That may lead you to speculate on a trade. So combining all of this knowledge together will always serve to give you that competitive edge needed over other competitors. The next lesson then will take structure over capital and trade flows. And of course, we have this chart just to give us a broad context. Global sources of funds in billions of dollars now, 2016 there, towards the end, just with year to date. So here we can see just, I mean, the sheer amount of capital trading between local economies and across the world. We can see where trade is specifically going in terms of capital flow from Europe. We have almost 7.6 billion dollars going to the US, 7.2 billion from Europe to Canada. So absolutely huge, while in result relatively small going across to the east. And again, where exactly is the US doing most of its business? Across Europe and round to Asia as well. So huge flows of capital will will have a very strong impact in the forex markets as well as many other assets. The movement of money around the global economy stimulates investment and business production. The relative strength or weakness of the capital markets can be shown through applicable capital flows, and this is particularly visible in the stock and bond markets, which is particularly of interest now at the moment. We see for the first time the US this week, and just towards the end of last week, the US 10-year Treasury bond just touched 3% in terms of the yield. So we're seeing a lot of capital flood into the US debt markets, as that return is seen as very, very appealing or attractive to bond traders. So it's very important that we can assess how that can affect the price of this asset that we as traders can look to speculate in. Trade flows can change drastically for any one particular commodity, and that's certainly the case when one country sees a shortage or doesn't have enough in storage of a natural resource. We'll see a quick and sharp shift in capital flow moving from one nation to another. And business between large financial institutions exchange large volumes of international currency on a daily basis. And this is one reason potentially why we discuss the forex markets to be, above all, the most volatile forex markets, because there's so much capital moving to and fro from different nations, to and fro from different currencies, of course, and always exchanging across one currency or another. So the amount of volume, the amount of capital traded across the currency market is particularly of a very high, large concern for us as forex traders. Then the next lesson will be discussing economic data in a lot of detail. And I have just this example here of a typical trading day we may see in the markets. What happens here? Well, wherever you are around the globe, traders are observing and trading on this data as they provide general signals to the health and underlying well-being of economies, and obviously to the health and underlying well-being of many of the assets within that economy. Data also provides many short-term traders with the volatility they need to exploit short-term trading opportunities. So simply put, if you're not interested in fundamentally what is going to happen as a result of the US CPI there at 1:30 p.m., You can simply look at the price action to judge how the market is moving, how the market is pricing in the new news in terms of relative to the volatility in the markets. And you yourself, you can develop the skills obviously to get involved and make short-term profits as well, simply by using your technical analysis. So that's key as well. This economic data always provides opportunity for us, and we'll discuss that in a lot of detail throughout that lesson. Moving on to week 3 here, we have it's very heavy in terms of the technical analysis. We'll be starting with components of technical trading and examining the theory and practice of technical analysis itself, before then jumping headfirst into technical analysis 1 and 2. So it will be very, very enjoyable because it will be very practical. These 2 lessons will be opening up the MT4 trading platform, placing trades, using all of our technical analysis that we learned throughout the lessons, and really building up our skill set, our trading toolkit of the availability to read price action and to use the different tools of statistical measurement and indication to actually look to spot trading opportunities. Then we'll move on to technical analysis 2, which we'll discuss some of the real key leaders in terms of developing statistical approaches to trading the market. So we have different trading strategies. We have Dow theory, and then of course Elliott wave theory. So very, very interesting. And many traders still, of course, use these as long-term trade approaches, and they often themselves actually witness or create self-fulfilling inflection points across a long-term pricing assets. Then of key importance, of course, finishing off week 3, we'll delve into the fundamental criteria of currency trading. So, I don't need to explain too much of that at this moment right now, because we know the sheer amount of opportunity involved in reading and assessing forex trading movement. If you're able to do that very, very consistently, then you will, of course, be a professional trader, successful professional trader for a very long, consistent period of time. So in terms of the components for technical trading, what we'll look to do is examine the theory of and practice of technical analysis, full price action analysis to charting patterns. So this is simply in-depth analysis of the Japanese candlesticks and how we look to trade price action. So we want to become price action specialists so that we can combine technical indicators, fundamental knowledge, sentiment analysis with what's actually happening in the price in the short term. So it's very, very important indeed. We'll learn how to effectively use technical indicators. We have an example here of some technical analysis just on screen. So really building upon the primary components of technical trading here. We have the cable market in front, which is the sterling US dollar market. We're seeing it trade a little to the downside here. So just with some price speculation that we can obviously look to delve into the markets, we'll really build upon technical theory. We'll discuss a statistical measurement of price and what that means. So here, as we can see across the technical lines here, the Bollinger Bands, what are known as Bollinger Bands, well, they follow the market, but we will delve deep into discussing what they mean, and I suppose to define them, in terms of how they relate to mathematics, they're simply a statistical measurement of price with a standard deviation from the mean. So it's very, very interesting field of study that we're looking to embark on. How to approach technical indication, and obviously that will delve deep into understanding when technical setups are there for you and when to ignore them as false signals, and discuss their various advantages and disadvantages. On the more price action front, we'll be discussing price action in detail, highlighting trading opportunities and placing some trades, of course, really getting involved into the practicality of trading. We'll be using technical indicators as well and looking at technical probability. So how do we increase our probability from obviously above 50%? If you do want to have a positive hit ratio, of course, that it will be of key importance to you. But how do we increase our technical probability of successful outcome over a sample of perhaps 100 trades? That is where you want to get your mindset into, so that you can develop a long-term consistent approach to trading these markets. Again, Whilst moving on through the technical practical approaches, we'll be building on technical trading strategies with Dow theory, trend definition, and Elliott wave theory. So that will be very enjoyable indeed. Then the next lesson will take the format of fundamental criteria of currency trading. So what affects the foreign exchange rates of global currencies? So we do know that they trade as a result of strength and weakness, but why are they moving also? What actually happens when inflation comes out, perhaps in the US, and it is a big miss in the markets? How are market participants looking at that in relation to the local economy and pricing it in across not only the forex pairs but a range of different assets? How currency rates help dictate global business and trade? So that's something we potentially don't think of course. And I'll give you one example. It was a big shock to the market, the Brexit decision, but it did cause a very sharp decline in the price of sterling. So sterling became quite cheap. So it actually, of course, you might think sort of organically, originally, that's going to be a very negative viewpoint in terms of global trade for the UK. However, as seen, it wasn't necessarily the case. The UK became much more competitive given its currency had depreciated and actually started to create much more output for the local economy. So it does serve to actually read much more into properly disseminating what is going on in the markets. And the trading of strength versus weakness, of course, that is the main focus when trading forex markets. The trading of volatility of forex markets as well, which we'll be doing practically as well. So if we're not concerned with long-term positions, we can make plenty of different trades and looking to fade moves, looking to try and follow price momentum in terms of strength and weakness, simply because the market is moving in that way. And we don't have to fundamentally analyze every single trade that we're in. So this is certainly the case for volatility trading. To bring us on to course overview, week 4, we will have the last lessons here with market correlation, and this will really build upon our skills to understanding how assets are priced together. So there are some markets, of course, that share a very strong correlation, a positive correlation, and there are some markets that will share a very negative correlation. And of course, we can look to trade them, whether we can look to spread the markets together. That would mean taking one long and one short position to actually make a small profit, a small loser and a larger profit, so an overall profit trade. How to get involved and actually providing us insight when to avoid certain trading conditions as potentially other correlated markets are moving adversely. So that will lead us then on to risk and risk aversion. Now, this is not only a discussion of risk management, it's going to develop our insight into how the investment community trades with the current risk theme. Okay, so to pick but a few examples, we know that the US dollar has a current risk theme. We know, of course, the equity markets has a risk theme where it obviously favors a risk-on approach. We know that the Japanese yen has a risk theme. We know that gold, of course, as a precious metal, has a risk theme, that it trades quite volatilely, with a lot of volatility when there is a high degree of market uncertainty. So we can look to actually not only speculate on these markets in question, but we can look to protect ourselves when we see that there's a financial uncertainty or potential financial meltdown or something like that, which may come as a result of crises. The last one more related there, I can think of the European sovereign debt crisis, of course, where a lot of money went into gold, considering the debt instruments or government bonds were very risky in Europe at that period of time. Moving on then to combining all of these assets together, we look to diversify our portfolio. So really discuss how we can spread risk through asset class diversification and how to develop short, medium, and long-term portfolios. So that's often misconstrued within the realms of financial trading, that portfolio diversification is focused in on the investment community where we may have trades open for 3 months or 6 months. That's not the case. Of course, when there is a change in risk theme across the markets, particularly when it's a sharp change, you can look to mitigate risks by choosing some assets to have a level of performance, but with that level of protection again. So you can actually take a very short trend trades across different assets to look to mitigate those risks through portfolio diversifications. both in the short term and the long term. And then developing a profitable trading strategy. So we'll, throughout the previous 15 lessons, we've really gathered a lot of experience. And that is the hope that we combine all of this experience together to put it to practice, to look to trade these markets and develop our own profitable trading strategy that is both structured, with discipline, with consistency, has a level of risk management, and corresponds with their own appetite for risk and expectation. What sort of profits do we want to make from these markets? So with market correlations here, we have oil as an example. Of course, we have WTI and UK Brent oil, two markets that effectively trade together, and we can see that these correlations exist so as to profit from levels of uncertainty. So that might be something we didn't discuss before, or you've never heard of before, actually looking to try and buy one of these markets and sell the other at the same time when there's a sharp divergence from the price of both assets. So they have, of course, a very positive correlation together, and a negative correlation with many different assets, particularly the Canadian dollar there as well. As professional traders, we must know how to exploit these relations, and that will be the context of our market correlations lesson. Risk and risk aversion, of course, is a very direct function in terms of developing your level of confidence as a trader. So we need to be quite risk averse for certain assets when they have an increased level of volatility. Individuals, of course, we understand as traders and as human beings, individuals have very different appetites for risk, and that is absolutely fine. What we must do is tailor for those different appetites for risk, not ignore someone who has a more prolific trading strategy that focuses on higher return. But as long as those risks are mitigated appropriately, then that it can be, of course, a very profitable trading strategy. So understanding your own appetite for risk and developing your trading strategy around that will be the main construct of many of these focus lessons. Trading strategy must include the assumption of risk. And of course, there's always risk involved inherently in trading the financial markets. There must be a focus on averting risk when trading. Okay, so once we enter a trade, our focus should not just be how much money can I make from this trade. If that's the case, you would effectively never look to take a loser. We must focus on averting risk when trading. So when I enter a trade position, I'm immediately thinking, even if the market's moving with me, okay, how can I limit the risk or my exposure on this trade? And following these sort of principles will help you become much more risk averse while allowing yourself to indulge in those riskier opportunities that are performing well for you. So it's about finding the balance here as a personal trader. Portfolio diversification, again, will take the main focus of our penultimate lesson, of course. And I just have a picture up front here that I'd like to discuss with you, because this is how many market participants like to trade. And if you can think of an example why, it will give you much more insight to look to develop your own portfolio of assets. So I'll choose one example, a pension fund who looks to perhaps get involved. Of course, they have to get involved on a monthly basis, not only trading equity markets, but they can get themselves involved in Forex, in trading bonds, in potentially looking for commodities like gold as well. Their main objective is simply to outperform a level so that they can provide cash for retirees or for their pensionees once obviously the life of their job work is of course expired, or they're obviously leaving after working for a period of 30 years perhaps. They're simply looking to make a return on a monthly basis for their pensionees. So they need to get involved heavily within these markets, and they have lots of capital to do so, but they need to mitigate risk. And now they're not specifically engineered so that they can have the know-how to get involved and trade the markets as professionally as professional traders. They're a pension fund. That's not their main mission statement. So what they do is involve themselves with portfolio diversification so that they're naturally spreading risk across different asset classes. And that's effectively what we can do under certain circumstances, both in the short term, the medium term, and the long term as professional traders. Then we'll look then obviously to finish off really with focusing on developing a profitable trading strategy. And towards the end, obviously, I'll hopefully I've built up a good relationship with many of the students on board here throughout the previous 15 lessons, that we can really get involved in asking questions. We'll be placing some trades, we'll be discussing the best technical techniques. We'll be just, having a real brainstorm session and using our skills to discuss, what technical indicators work best for particular markets, or what commodities perhaps really indulge themselves by following closely to their own supply and demand function, and trying to really develop our own approach, whether we want to be a fundamental analyst, a technical trader, or include both, of course, as a hybrid approach. Very important to really take this on board and focus in on your own trading strategy. So we'll focus on continual growth and consistency. We'll want to be rewarded for your time and effort. So again, when we talk about risk management, we don't want to force people to be too risk averse. We want to be rewarded for our time and efforts involving ourselves trading, but we need to find that balance, of course. So we do need to take on some risk, potentially greater amounts of risk when it is warranted, and that will hopefully allow you to outperform greatly in these markets. We must have a plan when markets move against you, of course, relating to risk management, and we focus on discipline and capital protection. So that's potentially the most important factor, I would argue. We must focus on discipline and capital protection. We don't focus on actually making money. So the question that should arise at the start of each month is, well, I made €3,000 last month. I traded very well last month and I kept my discipline. That was great. Now I want to make €6,000. That is or should never be the case, really. Of course, you can have an idea that you want to outperform, that's fine. But our focus should rely on, well, I traded very well and I was very disciplined last month. I want to emulate the same level of discipline and capital protection so I can outperform this month. Those traders, particularly those professional traders who do so, I find personally, always seem to be the best traders in the office. So that is a very key construct of professional trading that I hope everyone takes away from this particular lesson and many of these lessons as we go through to develop our own trading strategy as traders. And then we have, of course, 2 bonus webinars to finish off the lesson. We have a quantitative robustness evaluation of a trading system, which we'll discuss in detail, some very mathematical approaches to trading, and then a review of popular ways to trade. So again, because we went through the last 16 lessons, I'd like to have a review of how we feel as traders. I really open the room for a full hour of discussion to get your feedback, to discuss, scalping. So I was very heavily, in fact, I started my trading career as a scalper, scalping equity markets, and it can be very opportunistic. So, that may suit you as a personal trader as opposed to a swing trader or a long-term trader. Harmonic and fractals, we'll be looking at some, again, technical analysis, tramline approaches. So different popular ways to trade so that you can have more context to develop yourself and to your own style and to your own style of trading, and obviously something that's more suited to your own risk appetite when approaching the financial markets. So congratulations, that will take us to the end of this first and final lesson, albeit it was, of course, this is our overview for the Become a Pro course to see what is to come over the month ahead. So I do hope you'd enjoyed the total overview of the Become a Pro course. Really getting excited, obviously, for your participation here with the Become a Pro course. We have just finished the overview and we'll be delving into the first lesson tomorrow at the same time. So for now, thank you very much for joining us here at Forex Academy. We'll see you next time. Bye for now.